SoFi's stock price is up nearly 75% in just the last month, but if I'm right about this stock, it could have room to 3 or even 5x in price from where it is today. So here are my top 5 reasons to invest in SoFi today. And by the way, I personally own more than 1,000 shares in the company, so make sure to subscribe to see where I invest my own money every month and to help us hit our goal of 50,000 subscribers by the end of the year, if you appreciate someone who puts their money where their mouth is. So the first reason to invest in SoFi is the continuing short-term potential in their stock price, primarily driven by student loans. You might not know that SoFi started out as a student loan company at Stanford Business School back in 2011, eventually coming to dominate over 70% of the private student loan market. And their lending segment is still the core of SoFi's business. See, SoFi kind of operates like 3 businesses in one. You have their financial services, which includes things like the SoFi App, SoFi Relay, or the SoFi credit card. This acts like a top of sales funnel for SoFi, attracting new customers and bringing them into the ecosystem. They then have their technology platform, which runs both their business as well as other businesses for other fintech companies like parts of the Robinhood investing app on top of it. And then you have their lending business, the real moneymaker for the company, where they try to funnel their financial services customers into to make them more valuable. And this is where the greatest short-term potential for SoFi's stock price lies. SoFi makes loans ranging from home mortgages to personal loans to, of course, student loans. But while SoFi's personal loan business has been absolutely killing it for the last couple of years, student loans has been struggling ever since the government put a pause on all federal student loan payments. Because even though private student loans like SoFi's are still getting paid, people don't really need to refinance their public student loans into a private one when public loans currently don't require any payments. And that's put a massive dent worth hundreds of millions of dollars in SoFi's business since 2020. But what's interesting here is that dent isn't immediately obvious if you're not familiar with the company. See, SoFi has managed to fill that hole using mainly personal loans, which SoFi made a massive pivot into in 2020, with nearly $3 billion in personal loans originated in just the most recent quarter. But SoFi now expects the pause on student loan payments to end as soon as June 30th. And once people realize that they've been coasting off of not needing to budget for a loan payment every month, there will soon be a rush of people to refinance those loans in the next few months. And since SoFi already filled the hole left by their student loan business, that's like adding a bunch of unexpected profit back into the business. Considering there is currently $1.7 trillion in student loan debt in the US, with 93% of that being held by federal student loans that are on pause, even a small fraction of those borrowers refinancing to SoFi could massively improve the company's bottom line. Here are some numbers we can play with. If, let's just say, 1% of all federal student loan debt moved over to SoFi, that would be $17 billion in loans, more than 5 times SoFi's entire personal loan lending business today. Even a 0.1% refinancing rate would add 50% to SoFi's loan balances, which, as I mentioned, is already the area of the company that makes most of SoFi's money. Combine this with SoFi's home mortgages business currently sitting in a rut due to high interest rates, and we can see that there is a lot of potential for SoFi to see improvements in their business in the short term. I like to think of the lending business's potential like a giant stack of firewood ready to feed the furnace of SoFi's business, and we're starting to see SoFi achieve several financial inflection points that could be signs of flames starting to grow. Things like their adjusted earnings surpassing their stock-based compensation and seeing a positive variable profit for the first time. But we'll talk about those in more detail later in the video. The long story short is SoFi is set up well for some explosive short-term growth, which leads us to the second reason to invest in SoFi is what SoFi calls the flywheel effect, or their financial services productivity loop. I mentioned before that SoFi's business is almost like a funnel. They capture customers using their financial services like the SoFi app, then use the data they gather on those members to upsell them into the real money makers like a home mortgage or a personal loan. And while SoFi has talked about that exact strategy ever since their first earnings announcement as a public company, we're really starting to see that strategy's effect taking place. Anthony Noto, SoFi's CEO, likes to think of the financial services productivity loop as a ratio. On top, you have all their appealing high engagement financial services products. Products like Relay, like SoFi Money, like SoFi Invest, and SoFi Credit Card. You want the number of customers using these products to be as high as possible because more members means a larger base that you can cross-sell to. Then on the bottom, you have their lending products, personal loans, student loans, and mortgage loans. The higher the ratio of financial services products sold to loan products, the more potential there is to upsell. And so we want to see this chart continue to rise over time. Another way to think about this is in terms of vertical integration. You're probably probably familiar with horizontal integration, which is where a company takes over an entire industry, pushes out the competition, and basically becomes a monopoly. Vertical integration is where a company goes upstream to the products and services needed to make their product and downstream to the companies that use their product, and then they just take over the whole thing. Now, SoFi is doing literally this using their technology platform and by becoming their own bank, but they're also kind of vertically integrating their members' finances as well. Think about it. Today, a customer could sign up with a SoFi bank account and they could set up direct deposit to get the higher interest rate. SoFi can then see that that customer is paying a mortgage out of their account every month and make a personalized recommendation to move them to a cheaper home loan with SoFi. Maybe then that member uses a free certified financial planner from SoFi who helps onboard them to SoFi Invest to start saving for retirement. They then refer their kids onto the platform and end up using SoFi for a student loan. And that's a pretty realistic example. SoFi Relay is a service for credit score monitoring and keeping track of different accounts. And a super common use case is for SoFi to see that a Relay customer has a bunch of credit card debt and then offer them a personal loan to replace that high interest debt. Obviously, that's a win for the customer, but when SoFi does this, moving an existing Relay customer into a personal loan rather than signing up a customer for a loan directly, SoFi's variable profit increases from $800 to anywhere from $1,400 to $1,800. And you can see how as SoFi grows the number of members at the top of their funnel using financial services, that eventually drops down to the bottom line in the form of massive profits. And they've managed to set this up in a way that isn't scammy or predatory. It actually helps the customer, meaning it's sustainable. Which leads us into the third reason to invest in SoFi. And this one is maybe the most important to investors looking for the stock price to rise. Number 3, how much is SoFi likely to grow from here, and how does that affect their valuation as a stock? People sometimes talk about value investors. These are people who look at all the parts of a company's business and decide whether or not the current market cap of the company is worth the price based on the fundamentals. A good growth investor needs to consider both the company's current business value, but also how much the company will be worth 5 years from now as they continue to grow. So first, just considering value. One common way to value a company is the price to earnings ratio, or PE ratio. The PE ratio of the major banks averages around 8.5 compared to 13.5 for the smaller regional banks. So we'd probably expect SoFi to sit somewhere in the middle of those two numbers. But if we calculate SoFi's PE ratio using their adjusted EBITDA, which usually slightly overestimates earnings, they are currently sitting at a very high PE ratio of around 30. And if we subtract out costs like stock-based compensation, they aren't even considered profitable by GAAP accounting standards. But now let's go one level deeper and factor in growth. The US retail banking market, so banks that interface with consumers like us, is expected to grow at around 4.5% per year through 2026. That's basically in line with the broader economy, maybe a little bit faster, but it's nothing to write home about. Commercial banking is expected to grow a little bit faster globally at around 11% per year. But SoFi's growth is 5 to 10 times that. So let's rapid fire a few of SoFi's growth stats. Members, 5.6 million, up 46% year over year. Products, which includes multiple products being used by a single member, 8.5 million, up 46% year over year. Financial services revenue has more than tripled, up 244% in the last year, and total deposits up $2.7 billion in 3 months to $10 billion held in deposits, with 90% of those being direct deposit customers. So how much should the explosive growth that SoFi is experiencing factor into their stock price? Well, let's run the numbers out and see what they show. If SoFi grew their adjusted earnings at, let's say, 40% per year, in 3 years, their PE ratio would be 11, right in line with the other banks of their size. But if they then kept growing from there, any growth whatsoever would fall straight to the stock price. To keep a PE ratio of around 11, if they grew 20%, their stock would need to go up 20%. If they grew 50%, the stock would need to go up 50% to keep the PE ratio constant. Now, these are just examples, but let's see how likely they are to be true. Right now, SoFi makes money in the lending and the technology platform segments, but they lose money in financial services. That's because most of their new customers and marketing spend goes into financial services, and then it takes 12 to 24 months to recoup those marketing costs. But in their most recent earnings call, SoFi CEO announced that we are finally to the point that we're actually a positive variable profit margin for the financial services segment, which means we're actually covering all that customer acquisition cost. That's a big deal because it means that each customer SoFi brings in from now on means more money that SoFi makes. Starting now, more growth equals more money, which, using valuations like a PE ratio, means means a higher stock price, assuming that growth isn't already baked in. So we have the short-term stock price looking okay, the medium term looks pretty good too, but what about the true long term? Well, reason number 4 to invest in SoFi, there is massive market potential to disrupt traditional finance. SoFi estimates there are over 500 million legacy bank accounts with companies that don't make it easier for customers to move money around. Ever have to wait 3 to 5 business days just to transfer money? Those legacy banks don't recommend personalized products, and they don't use a technology-first mindset in solving problems for their customers. And that base of customers is ripe for the taking. The majority of banking customers cite inadequate one-stop shops as the main reason they tend to have multiple bank accounts. That is an opportunity for a customer-centric company like SoFi to win those customers over. SoFi's long-term vision is simple: to help their members achieve financial independence. And they want to do it by providing the best service possible on the market. And it seems like they're doing an okay job. If we look at SoFi's rating on the Apple App Store, they have a 4.8 star rating with over 180,000 reviews. And with SoFi continually expanding their features, offering true banking services with their acquisition of Golden Pacific Bank, adding crypto trading, creating a rewards program where you can earn free stocks by being a good loan customer, we can see how SoFi is differentiating themselves in this area. But also core to their vision of becoming the one-stop shop for banking is the third business segment, which I've mentioned but I haven't touched on too much up until this point: their technology platform. After a few strategic acquisitions over the years, SoFi is now running their own tech infrastructure to support their ecosystem of apps, and their ambitions here are even broader. SoFi wants to become the AWS of fintech, running not only their own apps, but running other fintech companies' apps too. SoFi already runs parts of competitors like Robinhood's apps on their infrastructure, and now with their banking license, they have what they need to become a one-stop shop for any fintech company to build on top of their platform. So here are just a few of the types of services that SoFi is rolling out. Connect, a natural language AI chatbot that helps with customer service for banks. Payments Risk Platform, or PRP. This pulls all the data from the Galileo Technology Platform, which is around 6 billion transactions per year, and uses it to detect fraudulent activity. Buy now, pay later. This one's actually really cool. You apply in the app and you're issued a virtual card that lets you use buy now, pay later anywhere, just like a credit card, but with totally different economics set up in the background. These are just the tip of the iceberg for the types of services SoFi is launching to start winning market share in the newly created fintech web hosting market. I kind of made that name up, but it's so new that I don't think I've seen anyone else even give it a name. And they are rolling out these services to their customers to continue winning market share from the 500 million legacy bank accounts looking for a better bank. And both of these markets are massive, mostly untapped, and provide a long runway for SoFi to work with. Which leads very nicely into the 5th reason to invest in SoFi. Number 5, SoFi has limited direct competition because the quality of SoFi's customers is so high. Now I know you could probably list a dozen potential SoFi competitors in the comments, but I would argue that none of these are direct competitors with SoFi. So what is a competitor? Well, I would define it as someone who can either take one of your customers or capture a customer you would have won otherwise. So let's take a look at who SoFi's actual customers are, because they're pretty different from your average r/Wall Street Bets user on Reddit. SoFi's average personal loan borrower isn't someone whose best alternative is a loan shark or a payday lender. SoFi's average personal loan borrower makes $164,000 per year with a weighted average FICO score of 747. Their student loan borrowers average an income of $173,000 per year with an average FICO score of 769. SoFi's customers for the most part are young, high earners who will continue to make more money as they climb the ranks in their careers. Here's an interesting example. SoFi Money customers this quarter spent more money out of their bank accounts than in any previous quarter, and yet they ended the quarter with even more money in their accounts than they started with. So even though the economy is slowing down, we're seeing GDP shrinking, the anti-work subreddit is angrier than ever, I think. SoFi's customers are making more and spending more than ever. Economically speaking, they are doing great. This puts SoFi in a really unique position where I almost view them like the Apple of fintech. Premium, great products, walled garden of services, and a seeming ability to always find people with money to be your customers. And in the same way that Apple is incredibly sticky by getting you to use one product before cross-selling you deeper and deeper into their ecosystem of apps and products, SoFi works the same way. Their goal right now is to have have as many direct deposit customers using SoFi as their primary accounts as possible, and then sell as many products as possible to those people. Getting a member to set up direct deposit is like Apple getting an iPhone user. It's just the hook to drag you deeper into the ecosystem. Right now, SoFi averages 1.5 products per customer in their ecosystem, but that's lower than it's eventually going to end up as, because a lot of those are new customers who are just signing up for their first products. So what does that mean? It means that once SoFi has completely saturated the market and picked up all the low-hanging fruits from legacy bank accounts, well, then SoFi has a whole second life of selling more and more services to each of their existing members. Now, I'm not saying that SoFi has no direct competition. It's just not that relevant right now when there is a clear runway in front of them with hundreds of millions of legacy bank accounts up for grabs. Now, do you need to invest exactly 1,000 SoFi shares? No, but I personally am investing more heavily in this company as their future becomes brighter and brighter. So let me know if you made it this far in the video. Go ahead and comment your average purchase price of your SoFi shares if you have any. It looks like my cost basis is around $6.45 a share right now. Don't forget to like and subscribe to help us reach our goal of 50,000 subscribers, and I'll see you next time.